Well, good morning, everyone. Welcome to our Wednesday morning trading session. Hang on a second here while I get you my monitor. Well, it looks like the markets just went crazy through the overnight session. Yesterday was a very active day. We'll see what kind of day we get today. An enormous opening gap. Let's take a look here at the Eagle and you'll see what I mean. So the markets left off, this is our Eagle trend trader, the markets left off right down here around 46.65, give or take a tick, and then boom, they just lit it up through the after hours. The Asian session a little quiet, same thing with the London session, but something really sparked the market, pushed it right through 4,700, which we were watching yesterday as a possible target. Market never did make it yesterday, though. Things kept bouncing back and forth. Made a swing high, made a swing low, made a swing high, made a swing low. So with that great big opening gap, I think I got to give the market a few minutes here to kind of get their bearings. It's always when you get a gap that big, you're always wondering, well, is it going to try to fill that gap? Or is that what you would call an acceleration gap, in which case the market's just going to continue higher from there? We'll see what kind of signals we get. In the meantime, let me give you a really quick overview. Ralph is having sound issues. Can I just get a sound check from everyone, please and thank you? Anybody? Oh, okay, thanks. All right, let me just let Ralph know. Okay. So a very quick overview of what you're looking at here. This is the diversified trading system. And we call it the diversified trading system because you're looking at the market from three different points of view. So we're diversified across the different market environments. Normally you have one signal, you try to use it, it works great one day, it doesn't work so good the next day, and you think it's your signal. So you go out and you find another new shiny indicator to put onto your chart, and before you know it, your chart is so convoluted you can't hardly make out what your signals are producing. Well, the diversified trading system takes a different point of view. We look at the market from three different points of view. Here in the top left, we have the Hawk Micro Scalper. This tool has been specifically programmed to pick up scalping signals. Top right, we have the Falcon Swing Trader. Again, this tool has been programmed to pick up swing signals. Here at the bottom, on the left, is the Eagle Trend Trader, and the bottom on the right is the Raptor. The Raptor is actually a compilation, if you will, or a hybrid. It incorporates elements of the Hawk, the Falcon, and the Eagle all into one chart, because we had some owners who were trading off of tiny laptops and they were asking for a one-screen system. So that's how the Raptor actually came about. Regardless of the tool that you're using, the signals all develop the same way. First, we're going to get a warning dot along with an audio alert. And after all the signal parameters are met, we get a triangle and a hash mark. That tells us that there is a trade, or all the trade parameters have been met. It's not necessarily a trade that we're going to take, however, because we're going to look for certain setups. We don't chase every single signal, and I'll just show you really quickly what I mean by that. So for instance, in the Hawk Scalper, These are the high probability signals that we're going to be focusing on. And you can see they're not really difficult to spot. We have things like the first micro-macro cross, which develops when the micro line, that's the thin one, crosses the macro line. That's a very high probability signal. We have a macro pullback signal, which occurs, everything stays in sync except the micro line goes out of sync. So again, not too difficult to spot. A 4-arrow consolidation, when the market starts to drift a little bit sideways, we start to look to see for a consolidation, and 4 arrows, the market normally rallies off that 4th arrow. There is a post 4-arrow consolidation pattern, and coincidentally this one is also a macro pullback, see, because the micro line went out of sync. And then toward the end of the trend, we'll get a red bar buy, which we can also sell. So we can buy the market a little higher for a scalp, or we can sell the failure of it. See, that's what we're getting right now here in the hawk. We're getting a red bar buy signal, and I'm waiting for that signal to print. We should be able to buy it up. I'm tempted to sell it short to see if the market, oh, there's the signal. Let me show you how this works. So the tool I'm using here on the right-hand side is the Trade Manager. Now you know what, we'll see if we hit the profit objective here. The Trade Manager's tool is to keep you from blowing yourself up, quite frankly. You see, we just hit the break-even trigger, and with a little bit of luck here, we're going to hit our profit target. Come on, get up there. The Trade Manager has this feature right here. This is the Risk Manager part of the Trade Manager, and it caps your risk at 2% of your capital. So no matter where you place your stop, darn it, they came back and hit my break-even trigger. So whether I keep my stop really tight like this, notice the risk amount, $420, or whether I run a more liberal stop. Okay, a little bit of a rounding error going on here, but notice the risk is still about $400. What has changed is the position size itself. This trade, I'm only trading 2 contracts. This trade, I think I was trading like 7 contracts or something. There we go. But the risk does not change. What does that mean? Well, that means I don't have to strangle my trade. I don't have to keep my stops ultra tight to try to manage my risk. I manage my risk here. So if 2%, don't freak out if that number seems high to you, if that $400 risk seems high to you. That's 2% of my trading capital. If that looks too high to you, dial it down. Risk 1% of your capital. You can still set up a trade like this. You're going to risk $125, and you have a better chance of hitting your target than if you do it the traditional way. You jam your stops in super tight and hope and pray the market doesn't look too far back. All right, a few other people with audio problems. They're saying the audio is cutting in and out. Try logging out and logging back in. Sometimes that fixes things up, and somebody's been telling me that with the GoToWebinar, when you log in, you need to check computer audio or something to that effect. I've checked the sound on my end, and everything seems to be working properly on my end, so I'm sorry. Unless my headset is on the fritz. And I don't have another one that I can try it against, so I apologize. But yes, try logging out and logging back in. See if that doesn't help out. All right, so there was a red bar buy signal. I just got tagged at break even on this little hiccup here. But it did go up to reach our profit objective. Now you can see we're working a green bar sell, so that may have been it. I may look to short this red bar buy. Oops, let's set it up like this. Now watch, I can risk it all the way up here. That's still only 2% of my capital. I can actually risk it much further. But the point is, you're not going to strangle your trades. You're not going to form a trade that's so tight that you get stopped out prematurely. Remember, your stop out is only a loss if it gets hit. I know, it seems very plain, but a lot of people don't wrap their heads around that a stop loss is not a loss until it actually gets hit. So now I'm going to look to sell the failure of this red bar buy signal. The other part of the trade manager is this portion up here. This is the profit manager portion of the trade manager. It is 16 different stop strategies that we can choose from. All right, I'm going to try to run this one out just so I can show you how the stop strategies work. So right now, my stop is up here. Let's say I wanted to automate my stop so I can go look at other markets. Well, how about we go with the ATR stop? So these blue dots represent how the trade manager would have managed my ATR stop. Let's say I think this is too tight at the current setting, so I choose to dial it back a little bit. I change the settings and it moves it back. Let's say I want to move it back a little bit more. Here we go. That looks like it's pretty good. If everything's to my liking, I just click enabled and voila. Now Trade Manager is going to manage my trade exactly according to this particular stop strategy. So that means I don't even have to watch that anymore. I can look at these other markets like the Raptor here. We just got a soft edge sell signal. And I may try to punch in on that one. So I'm just going to sell the market off of this soft edge sell signal. And here too, I'm going to choose a stop strategy. Maybe we'll go with the swing high-low to start. So that's going to put our stops above there. We'll enable a stop. Here too, I've got a break-even trigger, a profit target, which I've preset. Now you've probably noticed that this tool is slightly different than this tool. Because this is the trade manager. The tool I happen to have on the Raptor is called the Trailblazer. The Trailblazer is kind of a, well, I don't want to call it a stripped down version of the trade manager. It's not. It's a one-click system. We had some owners who were saying, you know, we're trading some really fast markets. I need a one-click entry system. Give me a system where I can just hit the buy or sell market buttons and I can get in, I can have my profit targets, I can have my stop losses. Well, this is where the Trailblazer originated. So you preset your quantities and your profit targets up here. You preset your stop strategy here. But it doesn't have that risk manager component. So you need to know approximately what your position size should be so that you don't overcapitalize on a trade in case things go sideways on you. So here with the Raptor, you can see we've hit, oh, hooray, we've hit our first profit target. Our remaining contract is in a runner position. So you see I have two contracts here. Quantity 1 at 20 ticks, T1 target. That's what T stands for, target. Quantity 1, target 2, 0. That means it's a runner. So we'll see if we can't run this one out a little bit. If we catch a bit of a break. I should get this trade to break even also. Now I can force a trade to break even as well, just with the break even button. And some of you who have been very observant have noticed the first micro-macro cross signal there. Oh, Bo, thank you for asking. Fantastic question, Bo, and I'm glad that you brought it up. Bo asks, why take a risk of $125 to make just 50? I know it doesn't seem to make sense, does it? But here's the part that most traders never get their heads around, and what actually is going to make a huge difference to your trading: probabilities. Most traders always stack the odds against them. You know, you've all heard the stuff about risk-reward ratios. Oh, I need to earn twice as much as I'm risking. Okay, that's fine. Here, let's work here on the Falcon because we've got trades going in the other two. So here on the Falcon, we've got a trend change signal. Let me show you where the whole risk-reward thing goes sideways. Okay, so you're looking at your chart and, oh, wait a second, I gotta set this up so I do it right. So you're looking at your chart and you're saying, oh, let's see, okay, we've got some support down here. So that support falls on this blue line. I'll talk about these lines here in a moment. All right, so this is how your trade sets up. Here's your signal. This is your trend change signal. We know this is a high probability signal. If you do things the traditional way, you're going to say, okay, I'll enter here. I'll put my stop loss here. I'll put my my profit target down here. Oh, well, it's a one-to-one trade. I guess I could take it, but no, I'm supposed to take 2-to-1, so I'm not going to take that trade. So you don't take that trade, and what happens? Well, okay, the market hasn't fallen off all the way yet, but the market falls off. It's a profitable position, but you're not in it. Actually, yesterday might be a better example because all right, here we no. All right, we'll stay with today's example. The point I'm trying to make is that you're trying to predict where the market is going. You're basing a go, no-go decision on the reward part of the equation. That's the part of the equation you have zero control over. The only part of the equation you have control over is the risk side of the equation. Oh, here, let's use this. This is a better example. This might highlight it better. You're getting a sell signal. It's a high probability sell signal, but you're looking at this and you're saying, oh, there's all this support nearby. So you set up your trade like this, and you use this as your profit target, and you say, oh dear, I can't take that. I'm risking twice as much as I could potentially earn, right? So you pass on the trade, the market goes down, hits your profit target, and whereas you could have earned $100 on the trade, you end up not taking the trade or passing on it. So then you look at it and you say, after a while you say, oh, well, I'm getting tired of missing out on those profitable moves. So I know you start to reverse engineer the trade. So you look at here and you say, okay, I know there's $100 profit. So I need to only risk $30 so I can make 100. Right? That's what you end up doing. However, look at what you're doing here. You're placing your stop. Sure, this is a 3-to-1 trade, but your stops are so tight. What do you think the probability, not the risk reward, what do you think the probability of this trade working out is? Probably not that good, right? If you had your stops up here, what do you think your probability of this trade working out is? Probably a little better. What if you had your stops up here? What do you think the probability of the trade working out is? What do you think the probability is that, you will go from here to your profit target before you hit a stop loss up here? Probably pretty darn good, right? You're only asking for a very little profit and you're giving the market a whole lot of room. But you say, oh, I can't risk it way up there. I'm going to risk too much money. Aha, no you won't, because you're capping your risk at 2% of your capital, or 1%, or whatever's comfortable to you. So no matter where you place your stop, if you place your stop here, if you place your stop here, if you place your stop here, you risk the same amount. So if you're going to risk the same amount, wouldn't you rather have a stop that's a little bit further away, or perhaps above a technical point, where you could say, all right, if the market reverses and stops me out here, then I'm obviously on the wrong side of the trade. But okay, you're on the wrong side of the trade, but you haven't lost more than you can afford to lose. So even though you took a losing trade, you didn't just blow up your account. You just didn't break your account in two, right? Think about it a little bit. This is a very important concept. Like I say, a concept that most traders never wrap their heads around. So they keep missing these trades, these profitable trades, because they think, oh, well, I can't take that trade because I can't make it a 2-to-1 or 3-to-1 reward to risk ratio. And all this time, the market is making the money, or potentially making the money, and they're not in those trades. So what you should do, or what I believe you should do, is you should focus on the probability of the trade. You get a high probability signal. Do you take it? Yes. Now the question just becomes, where do I place my stop loss? Well, you could place your stop loss here. And let's get our auto profit target going. So you could place your stop loss here, in which case I'm going to risk $300 to make $300, or I can place my stop loss up here, in which case I'm going to risk, again, a little bit of a rounding error because the contracts, the number of contracts. But I'm going to risk, $200 to make $100. It doesn't seem to make sense. And yet, if the market came down and did one of these and came up short of my profit target, let's say I'm not running my auto break even at this point. I have an auto break even target about 80%, 75 to 80% of the way to the profit target. I figure if the market goes that far and doesn't hit my auto break, or doesn't hit my high probability profit target, I may as well take a break even stop out. But let's say for a moment the market turns and starts to do one of these. Do you think the market's going to go straight here through the 205 mark, through this high? Now let's think about this for a second. The buyers have been very, very strong, right? Huge rally. Where did the sellers stop the buyers? They stopped them right here at 47.08. Do we think the sellers are just going to walk away after putting the brakes on this huge uptrend? This is like a freight train coming at you, and the sellers dug in here at 47.08. Do we think it's going to be likely that the sellers are just going to walk away and the buyers are just going to go boom right through there? No, probably not. So it's probably do something like this, and then let's say it even gets this high, and then we're going to see one of these. We're going to see the sellers step in one more time. That's our cue to start rolling our stops. And it will probably do something like this, and we can continue to roll our stops down. And we'll probably get one more bar, so we can continue to roll our stops. And then somewhere through here, the market's going to start to reverse. And at this point, we may get stopped out. So while my initial risk may have been very lopsided, by the time the trade sorted itself out, if in fact the market did not hit my high probability target, I could probably have managed this trade to the point where I would end up with about half, losing half of what my initial risk was. So again, just because you start with a big risk doesn't mean you need to finish with a big risk. And you should think of your stop loss as a safety net. Put all that stuff about risk-reward ratios behind you. You know how the pros do risk-reward ratios? They do it in hindsight. What? Yes, it's true. Let me show you. This is how the pros do it. Okay, so you get a high probability signal. They set it up like this. They go like this, and the market hits your profit objective. You know what the pros do? They now recalculate and they say, okay, well, our risk reward, what was our risk after our trade got engaged? It was this bar right here. You can't see the high because the arrow printed on it, but this was your risk. Why do I say that? Because the signal engaged, and this is as far as the buyers came against your position. Something like that. Okay, so then the pros go, there's my risk. Oops, wrong button. Stop it. So there's 1 times my profit target. Oh, look, there's 2 times my risk. That was a 2-to-1 trade. Good for me. Look how smart I am. That's how the pros do it. They do it in hindsight. They don't necessarily, or they'll do it on the fly. I shouldn't say necessarily in hindsight, but they'll do it on the fly. So they get their trade, the market brings them in, it retreats against them this much. Now they recalculate and they say, okay, here's my risk. Where should my profit target be? If this is how much the market is retreating against me, actually at this point here, they'll probably start their recalculations and they'll say, okay, where's twice my risk? And they'll say, oh, it's right down there. So that's where I'm going to take profit. And lo and behold, that's where they took profit. Right? So that's how the pros do it. If you want to subscribe to that risk-reward school of thought, it's not that it doesn't have some validity to it. However, to forecast in advance is futile. See, the market's almost doing exactly what we said it might do. If, for instance, we didn't stop out here, so we're short here, our original stops are up here. Let's say we decided to try to run it out. We decided to try and see whether the market's going to fill that huge opening gap below. Okay, so the market's retreated against us, and right now, you know, we're saying, oh dear, why didn't I take the profit when I had it? And oh, I'm so silly, and all that stuff. Never ever beat yourself up about a trade, by the way, but that's a whole other story. Okay, so now we're looking for the sellers to come back, right? We know the sellers got active around 47.08. Oh, and Bo's just full of great questions here. I'm going to get to the other ones as well that you're asking here. They're all good questions, so please just hang in. So we're waiting for the sellers to react now to this 47 area, 47.08. And once they do, if your stops were still up here, then you can start to roll your stops down. Now, even if the sellers don't react, even if the market continues higher here, you can still take a little consolation in the fact that you did not lose more than you could afford. I've spoken to two individual traders who have blown up. One blew up a $20,000 account, the other one blew up a $25,000 account in a single day. Talk about risking more than you can afford to lose. Most traders routinely risk nearly 10% of their capital, especially the small traders, will risk 10% of their capital. 5% or less is considered prudent. The reason is that, well, most professional traders know there's a very real statistical probability that you'll take 10 losing trades in a row. So if you're risking 10% of your capital on average, and you're losing 10 trades in a row, let's see, that's, 100% of your capital. All right, so the sellers did step in, and they're starting to force the market down, so we can reduce our risk a little bit. And maybe at this point, I would turn the trade onto autopilot. And let's see where no, those are on the wrong side. So I'll go with my swing high-low, and we'll back this up a little bit. Oh, you know what? I'll go even with maybe parabolics are on that side. No, not yet. See, we got lots to choose from here. All right, we'll go with the bar high-low strategy. There we go. So I can employ the bar high-low strategy now. It's going to keep my stops 3 bars back, 3 ticks off the high. This is all I'm going to give the buyers at this point. So if the sellers don't get busy and push the market down, then I can say, oh, well, I found myself on the wrong side of the trade. I should have maybe taken profit. It was a good signal, but at least I did not lose more than I can afford. I can't tell you how, well, maybe comforting is too strong a word, but it takes a lot of stress out of your trading, especially when the market's moving against your position. It takes a lot of stress out of your trading knowing that you haven't overcapitalized your losing trade. And you know, the flip side of the equation is Trade Manager will always make sure that you correctly capitalize your winning trades. So you're going to maximize your profits and you're going to minimize your losses. Do you know how most traders do it? Most traders will start the day and they'll say, okay, I'm a small account trader. I'm only going to risk 3 contracts. So they go out and they risk 3 contracts, and on one trade they may have $300 at risk, and the next trade they may have $700 at risk, because it all depends where they place their stop loss. So let's say you got hit on the $300 for a loss, okay, so you're $300 in the red, then you get tagged for the $700, now you're down $1,000, and now you're starting to think, oh my gosh, what am I doing? The market's got my number today. I better dial down here and I'll take only a single contract. And what happens? That's the trade that works out. And so let's say you make $100 or $200 on the trade. Well, you've lost $1,000, you've made $200, and now you're still $800 in the hole. Whereas if you had correctly capitalized your position, you could be at break even, or maybe even show a small profit or at least a smaller loss. And believe me, it works. I'm not going to go through all the numbers here today, but I know Adam's got a webinar planned in a couple of weeks for NinjaTrader, and we'll be addressing that issue. It does work. If you sit down with paper and pencil and work through it, you'll be amazed what difference that'll make. Okay, so Bo's asking, that's reward based on market geography? Well, yes and no. They're high probability profit targets that we have developed for each of our tools. So with the Hawk, our high probability scalp target is $50 per contract. The Falcon and the Raptor, $100 per contract. And with the Eagle, it's $200 per contract. So here on your scalper, you may say, what, $50? How can you make a living on $50? It's by correctly capitalizing yourself, folks. So let's look at this. Let's say we took this trade. I'm going to use the dots here. If this trade goes on, this is a first micro-macro cross signal, by the way. That's one of our high probability signals. So if this trade works out, I've made $150. That's because I'm taking 3 contracts. Did you know that you can make a living on 2 $50 trades a day? Bet you didn't. Most people don't. The trading is not like you're working in a production type atmosphere. Trading is not, if I produce more widgets, I make more money. Trading is not, if I take more trades, I make more money. In fact, the exact opposite tends to happen. If you take more trades, you tend to lose more money. In trading, you need to focus on your high probability setups and then correctly capitalize yourself. So for instance, if you take just 2 $50 trades a day, you will make $100 per day. If you traded 25 contracts, you would make $500,000 a year on 2 $50 trades. And you say, well, gee, Eric, that's great, but I can't afford 25 contracts. All right, well, what if you traded 5 contracts? That's still $100,000 a year. Can't afford 5? Well, what if you did 3 contracts? That's $60,000 a year on 2 $50 trades a day. But they have to be high probability trades. We're not getting a whole lot of follow through here today. I see this one would have hit my break-even trigger also and tapped me out at break-even. So I'm wondering if we're going to see a rather sideways kind of day today. If you traded 1 contract twice a day for $50 per contract, you would make $20,000 a year. It's sure a whole lot better than you're going to get at any bank or any mutual fund. Trading that way also takes a lot of pressure off of your trading. You get to hold out for those cherry trades. You get to wait for that first micro-macro cross and then set it up and place your stops. And the market goes up, boom, there, 1 down. And then a little while later, here's that red bar buy signal. Let's say you chose to take that. Boom, I'm done. And the day's just started. You're 5 minutes into your session and the day is done. Or could be done. Let's say you want to hold out a little more. All right, here's another first micro-macro cross. That one I would probably risk up there. Boom, another high probability trade. So long as you wait for the high probability signals, you're going to do all right. So it almost looks to me like they're wanting to pay off here to the short side a little bit. The buy signals aren't really following through. They may try to get into that gap after all today. Oh, I was going to tell you about the lines on here. There's some add-ons on each of these tools. The add-ons are standalones, meaning that you can use them on any chart. These lines that we have here, these are the Ultimate Support and Resistance Suite. They forecast these support and resistance zones for today's trading. There's 21 lines. And no, they are not pivot levels or pivot points, and no, they are not Fibonacci retracements. They are much better, and I'm saying that all modesty aside, they are much better. Gold line is the median line. That means there's 10 lines above, 10 lines below. The blue line is the primary resistance. Other blue line, primary support. These three lines tend to set the tone for the day. If the market gets above here, we'll usually see a bullish day. If the market gets below here, we tend to see a bearish day. So very popular add-on, by the way, those support and resistance lines. And as I mentioned, they'll work on any chart. Okay, we're getting another sell signal here on the Raptor. I'm going to set up my sell stops. I'm just going to park them there, see if they fill it. And I'll have my swing stop enabled. Let's go back a little further. Oh, that's not going to do it. A couple more then. All right. I'd like to, again, I'm just going to cover above this high. In case they're not ready to head lower. So this particular setup that we're looking at here, this is what we refer to as a soft edge sell. A soft edge sell must always, always, always be preceded by a test of the extreme. In this case, the extreme is the high and a failure. And then we come out and we're producing a sell signal. So that's the soft edge sell. Okay, there's a few more questions here, so let me just get back to your questions. Bo's asking, high probability signals subject to a high win rate. Yes, but let me tell you something about win rates. You know, we all get these spam emails, and I can't believe it. I got an email yesterday or the day before that was boasting 100% system, or system returned 100% for 60 trades or something ridiculous like that. It used to be when those spam emails first came out, they were boasting about win rates around the low 70%, and then they went to 80%, and then now they're in the 90%. I'll tell you right now, in the E-mini S&P, so here, you E-mini S&P traders, I will tell you right now how you can have a 98.5% winning system in the E-mini S&P. And no, I'm not making this up, and no, I'm not lying. 98.5% of the time, the E-mini S&P will move one tick. A little bit of a letdown, isn't it? We all think, oh, 98.5% winning signal, you know, I'm going to capitalize on moves like this. No, you're not. 98.5% of the time, the E-mini S&P will move one tick. So now when you get those spam emails in your inbox that are boasting such high probability win ratios, you know how they're doing it. They're going for very, very tight profit targets. And there's a difference between having a high probability target and a target that's just simply a waste of your time. Nobody in their right mind would take one tick in the E-mini S&P unless, of course, they're a high-frequency trader and they're trading thousands of contracts and they're getting their commissions at pennies on the dollar, whereas you and I would pay that $12.50 profit. Well, I think pretty much all of it would go to the broker and the exchange. So don't be suckered by those high probability spam things. The high probability signals that I mentioned here are based on testing. The tools all underwent rigorous testing actually for 9 months before they were released. And at that time, we identified the high probability signals, the high probability targets. The DTS system, by the way, is non-tweakable. You can add things to it. For instance, I was working with a fellow not that long ago. He loved Bollinger Bands, had to have them on his charts. I said, go ahead, put them on your chart. He just had to have a Bollinger Band on his chart. So he says, can I do that? I said, sure you can. So he put Bollinger Bands on his chart, and his charts looked like this. I said, that's fine. The only criteria is, does this help you make a decision? So when the eagle is producing a buy signal, does having the Bollinger Bands on there help you make a decision? If the answer is yes, then by all means, keep them on there. If the answer is no, get rid of them because you don't need them. You don't need to have Bollinger Bands on there to recognize that this is a trend change. We've had the retest of the lows. We're challenging the highs. It's a higher probability signal. So what do? It's a high probability signal. We take it. We allow the risk manager to control our risk. So in case we're wrong, we don't destroy our account. We don't shove the stops in so tight that this trade has no room whatsoever. In fact, I should show this signal here because that's the first signal. We don't shove our stops in so tight that the market brings us in and then starts peeling against us. Oh, whew, caught a lucky break, but look how close we were to getting stopped out. Much better to place your stop at least a functional point. You know, if the market breaks through here, you can say, yeah, okay, well, the buying took off from here, so if it breaks through here, it's probably a good time to leave. But the high probability signal allowed you to realize a profit. And you didn't need Bollinger Bands there to tell you. But again, if it helps you make a decision, then by all means, go ahead, use it. Bo's asking, do we reduce our risk by adjusting our initial stop loss when we are in profit or when the market is going against our position? Well, usually I start to adjust my stops when the market is going in my position. So here's my initial risk, right? So I'm going to allow the market to risk. I'm going to allow this much risk. If that is too dear to me, I need to make these adjustments up here. I don't want to be risking an amount that I can't think straight over. I'm working with a fellow right now who's, he was telling me about his gambling adventures in Las Vegas, and he's a fairly well-to-do individual, and he's telling me about how he'll sit down at a hand of blackjack, and he may have $5,000 playing on a hand, and it doesn't bother him, and yet if he has $500 at risk on a trade, he can't stand it. So, he needs to either get comfortable with that risk amount or he needs to risk an amount that is insignificant. I said, dial it down to $200. That's a nice dinner out. You're not going to miss that. But it has to be an amount that you can stomach, an amount that isn't going to make you crazy. And everybody's got a different threshold here. With the trade manager, you can dial down your risk. Well, we don't have a signal there yet, but you can dial down this risk. If you don't like, this isn't a signal, but I'm just showing it. If that's uncomfortable, if the $300 is uncomfortable, change the risk amount. Maybe make it 1.5. Oh, 1.5 is not enough. Let's dial it down to 1%. So we've got ours here. Okay, $160. All right, if this trade goes against me, I can live with a $160 loss. I'm not going to feel real bad about it. So once you reach that point, then go ahead. You can take the trade signal. You don't have to fret about it. You can manage your trade with a clear head. Very important. Muy importante, as they like to say in Mexico. All right, so we got filled on our soft edge sell. My initial stops are up here. I'm not going to roll the stops just yet. I do have an auto break-even trigger in play. Tom is asking, can you order Trailblazer and Trade Manager together? Yes, you can. They kind of do the same thing, though. For instance, let me show you here. Well, here we'll go on. No, doesn't matter. If you like the one-click system of the Trailblazer, you still have the option of punching into a trade here. It will default to this quantity up here. You can still have a stop enabled, so watch what happens. So I get my short order, I get my profit target, I have a break-even trigger, but what's missing? No profit target. So if I punch into a trade, the trade manager does not default to the risk component, it defaults to the quantity component, just like the Trailblazer does. The chief difference between the Trade Manager and the Trailblazer is that the Trailblazer will allow you profit targets, and the way I have my profit target set up right now, I've got 2 contracts. I'm going to take profit on one. I'm going to leave one to run out. But so we just hit our break-even trigger. You see it automatically took my stops from up here, rolled it to break-even. Now if we get a little bit of a lucky move here, we'll hit our profit target, and then you'll see that my quantity will change from 2 contracts to 1 contract. Come on, get down there. You know you want to. Ah, yes, oil inventory. Robert's asking, what is that red and blue squiggly line that you have? Oh, I better cancel this trade. That wasn't a real trade. Robert's asking, what's that red and blue squiggly line on your eagle? This is, this was actually suggested to me by Mike Filigera. He uses the DTS system to trade the stock market. We just use it as a little bit of an added filter. It's actually an ATR, average true range. And what you do is you can go to your eagle and you can scroll down here to your IW indicators, and you're going to look for IW TM ATR trail. You double click on that and it shows up in your assortment down here. And it's actually what Trade Manager uses to plot your stops. So, I guess a couple of years ago now, Mike was saying to me, you know, Eric, it works out pretty well on the Eagle if your Eagle trades are in sync with your ATR. I said, oh, really? So I started looking at it, and yeah, sure enough, if he wasn't right, that when the ATR is in sync with your signal, it just seems to have a little better follow through. So we've started to incorporate that. If the ATR is against our signal, like it is here, we wait for the ATR to flip over to be in sync with the signal. So that's what that red and blue squiggly line is. It's just your ATR. All right, they're still hovering here just above this morning's lows, deciding whether or not they want to take the trade lower. Bo's full of good questions this morning. Bo asks, so is it better for a new trader to concentrate on just one asset, for example, crude oil futures, and maybe one trading method? Yes, I think that's the way to go. As far as trading markets to follow, and yes, Tom said crude inventory coming up, so let's bring crude oil over here. Here's crude oil on the Falcon. I would not start with crude oil unless you're extremely well funded. I know crude oil is a very sexy market. Coffee and crude oil are the two most popular markets in the world. The E-mini S&P is the third. Coffee, oh, it's just crazy. Don't even go there. Crude oil is equally as crazy, not so much of late, but the thing with crude oil is the risk amounts. So let's say we were looking at taking this trend change signal right here on crude, this guy right there. Where do we cover the trade? Oh, I can't cover it below there. And this is that's 2% of a $20,000 account. I can't cover below this swing low. See, Trade Manager also prevents you from taking a trade you cannot afford. So what ends up happening is now if I really want to take the trade, I got to find someplace I can afford to get in. And remember, the closer you keep your stops, the more likely it is you're going to get stopped out. Right? So you don't want your stops overly tight, even though this has worked out. If you haven't ever looked at it, I would recommend the NASDAQ. $5 a tick. It makes some very good intraday moves. The margins are low. You can trade it for only $500 per contract. So that means even if you're trading a smaller account, say $10,000, you can still afford to take 2 contracts on a position, which means you can take profit on some of your position. You can try to run out the rest of your position. It gives you some management options, things that you would never have trading crude oil. But yes, I think as a starting trader, it's very prudent to learn one market. The signals are the signals, that's true, but markets have their own little personalities. They have their own little quirks. For instance, with crude oil, I can tell you that the average daily range is anywhere from $800 to $1,000. And once it's made that range, forget it. It's just going to go dead sideways. You may as well book a tee time and go golfing because it ain't going to move. The NASDAQ, however, the ranges may not be quite that big, but that doesn't mean you can't pull $1,000 out of the NASDAQ market. We did that actually not that long ago, a few days ago. The market was very responsive to our signals. We had bigger follow through. We were able to put a few runners on, and by the end of the morning, we were up over $1,000 in profit. All right, so oil inventory, this is usually when I highlight the OCO function. What I do like to see is it within a range and the market kind of trading in the middle of the range, you know, something like this. If we were going into crude inventory now, I could bracket the low, I could bracket the high, and just let the market trade the breakout. This, however, is not a sideways market, but I am going to show you the OCO function all the same. I'm going to buy above the resistance line up here. I'll sell below the maybe I'll sell below this resistance line here, the primary resistance. So with the OCO function, I better get a stop enabled. And I better dial that bad boy back. Oops, that's not what I want. Okay, well, I'm at break even now, so we'll just let that go for a second. So what I was trying to show you with the OCO function is that the orders are live once you put them on your chart, so I tend to put them away and then pull them in. And that when one order fills, the other one cancels. So sorry, that just kind of flew by really quick. And here's crude oil now falling off the map. I guess I better get serious about protecting some of that profit. Maybe I'll go with my parabolic stop. That's going to be a little bit more aggressive. So I'll engage the parabolics, and now the trade manager will manage my trade according to the parabolic strategy. So we're sitting now on the primary support. Hopefully it's not going to bounce too hard. Come on. Come on, give me that swing. Be nice. Bo says, I love the NASDAQ, but it just doesn't move. Maybe it has to do with my personality. Yeah, I know what you're saying. Crude oil, it can be a wicked market, though. Remember, your objective here is to make money. There's cheaper hobbies. There's a lot less expensive hobbies than trading, especially trading crude oil. So that was actually a very responsive inventory report on crude. It isn't very often that we see a nice smooth move like that. As you know, it can be ultra violent at times. We did get a trend change signal right here on the Falcon, and actually the market was progressing slowly enough that you could take advantage of that sell signal. We also had signals on the Hawk. Let me bring the Hawk over here and show you. So we had a first micro macro cross way up here, so you could have been short crude oil. Oh no, sorry, that's inventory. Just going into the inventory report, we had a first micro macro cross signal. Nice follow through. Also producing a macro pullback. I don't know if you can see the micro line just out of sync there for a bar or two. So another chance for a little scalp through here. Had a couple of 3-arrow consolidations. Crude oil, you don't get the 4-arrow consolidation, you get the 3-arrow consolidation. The market tends to consolidate for 3 arrows and then go. Here was another one. So lots of opportunities this morning in the crude oil market on the Hawk. And then here was our macro pullback signal. All right, let's see what our NASDAQ trade is doing. Oh, they're still sitting here on the support. If they can break this low, this is where the buyers tried to get busy again. If we can break through that low, we should get a little bit more follow through. So we've banked $100 on one trade. We've got another $80, $90 in open profit on the other. Let's see if somebody's going to dip their toe in the water here. Oh, I haven't mentioned this tool yet. This is the Geiger counter. This is a great little tool. The Geiger counter is essentially a tape reader. This is another one of these add-ons. Oh, and Tom's asking, can I see crude oil on the Raptor? Yes, sir. Let me load that up for you, and I'll bring it right over. So with the Geiger counter, it's essentially a tape reader. So you get a visual of the time and sales. You can see the market fairly balanced, which is pretty much what we're seeing here as well. We also have this needle on here, which goes red when the time and sales average tends to be more bearish, white when it's neutral, green when it's more bullish. But this little dial that you see hopping back and forth here, this is quite helpful. The Geiger counter came about because we had one of our owners say, you know, I'm in a trade. Can you give me an indication when I might need to get out of a trade, when the market bias is shifting? Well, that's what the Geiger counter does. If you see how it pulled over here and it's trying to hold and hold and hold and hold, that tells me, oh, see there, it's holding, it's holding, it's holding. If it'll do that for like 3 or 4 or 5 seconds, that shows me that there's a whole lot of buying pressure. And look, we see the market start to move up. Same thing. Now, if ideally I'd like to see it pull here to the short side and hold and hold and hold. Oh, they're trying hard. When you get that type of activity, that shows you the buyers or the sellers trying to chew through those orders that are there. And when that happens, you should anticipate that you're at least going to get a very short-term move lower. So if we were in this trade and we had a whole lot of open profit already, we might say, well, maybe I'll adopt a tighter stop strategy. You know, maybe I'll go with parabolics or with the bar high low or something that's going to protect more open profit. So very helpful that way. So that is what we call a system add-on. You can consider it a standalone. It will work on any chart, not just a DTS chart. It'll work on a 5-minute chart or a 250 tick chart or even a point and figure chart if you wanted. All right, let's take a look at crude oil here now on the Raptor. And yeah, right about here we got a trend change signal on the Raptor. Drifted a little ways. Our cloud crossover signal came a little bit late, but that's just because the inventory report sent it a little bit lower. So we also got a cloud crossover signal here. So the two signals on the Raptor, this one right here, our trend change, and this one right here, our cloud crossover signal. And you can see yesterday crude oil, at least toward, no, for most of the session, the North American session anyways, just a sideways mess, no real decent signals out of that. You did get a double pullback signal right here, enough for a small profit, but nothing substantial. Big move in crude oil came through the overnight, or from yesterday's, or the day before session, sorry. During the overnight, London open, boom, down she goes. And then the North American session was flat again. European session, down she goes. And then North America open, well, we saw a little bit of a rally, but pretty dead for the most part. So today with crude inventory, we can all expect prices at the gas pumps to go down again. Oh dear, I'm so funny. All right, so there's crude oil on the Raptor. Oh, by the way, if there's any market you would like me to take a look at for you, please don't be shy to ask. Getting a little bit of a double bottom here. Robert's asking, Eric, can you please explain that L-shaped thing around the Raptor, around the active bar when it's red or green? Okay, that's tied in with the Geiger counter. I forgot to mention that. That's what's called the trade indicator. You don't see one here yet, but we'll wait for a second because this bar is so neutral. The trade indicator will give you the very short-term bias of, oh, see, there it is, of the last bar. So right now the trade indicator is saying, oh, well, it did say for a moment that the short-term, very short-term bias is bullish. See there? But every time it goes a tick lower, it changes again. So that little envelope is tied in with the Geiger counter. So if you're watching this and you're short and you see it go green and green, and then, well, let's say it was a little deeper and it goes green and green and green, again, you may choose to adopt a different stop strategy, or perhaps just punch out with your open profit. Sol is asking for the 30-year bond. Hang on 1 second and I will dial that up for you. And Phil is asking about a Forex market. Would you mind if I gave you the futures equivalent? I'll show you the euro. I've also got the British pound. I'm kind of restricted in my Forex data feed. Bo's asking, what is your ideal average target on the NQ day trade? Well, it depends on the tool that I'm using, right? We have high probability targets for our signals. So again, with the Hawk, it was $50 per contract. The Falcon, the Raptor, $100 per contract, and the Eagle, $200 per contract. These tools will only produce signals if the market conditions are right. So if the market is not in a trend mode, the Eagle Trend Trader is likely not going to produce a high probability signal. You can also use the Day Ranger. This is another, speaking of standalone tools, the Day Ranger is sometimes very helpful for trying to gauge what the market volatility is and what your profit objectives could be. It measures the current range relative to the longer term ranges. So we have 30-day, 10-day, and 5-day averages. You can see 30-day average 200, 10-day average 136, 5-day average 123. So that tells us that the market is contracting a little bit. So by looking at that, you could say, all right, well, the average seems to be shrinking. Maybe I'll look at 120 ticks for guesstimate today's range at 120 ticks. Therefore, let's say I want to take 20% of today's range as a profit objective. So I'd be looking anywhere from 20 to 24 ticks as a profit target. Or let's say I wanted to offer up 10% of the day's range as a stop loss. So I could run a 12-tick stop loss based on what the market ranges are like. So that's another way you could do it. Well, sure. Bo says 10% of the day's range as a stop loss. Remember, this has to do with volatility, and your stop loss is not a loss unless it gets hit. So let's say we're going to offer 10% as a stop today. So that's going to be 12 ticks, and we're going to look to short. So we're going to go 12 ticks off the high. This isn't a signal, but we'll just demo it anyways. Oh, where's my fixed ticks? So there's my stop loss. So Trade Manager contains my risk, right? It's capped at 2%. If this amount is too dear to you, then you need to dial it down. And once again, this is not one of our high probability signals, but we'll just do this to illustrate a point. I just mentioned that not because the signal may fail, but I know sometimes people in the room shadow my trades. So I try to let you know which is the high probability signal and which is not. So I don't get the nasty email afterwards saying, hey, Eric, you bonehead, why'd you take that trade? All right, so now we're 10%, we're offering up 10% of the daily range as a stop loss, and we're above the high of our signal bar. So if the market retreats against us, that would be 10% of our range. And if I could have set a profit target at, say, 20% of the daily range, which would obviously be twice as much. But we're going to go for our high probability target. And again, you see the fixed tick strategy automatically capping 10% on each bar. So as each bar goes lower, it gives you that 10% range off of the high of the last bar. So we've now hit our break-even trigger. So we keep our fingers crossed and hooray, there we go. Okay, a couple more questions here, and yes, I will get to all of them. Bo says, okay, Bo says, I need that information in ticks, please. Well, it depends on the tool, right? So if a 50 tick target is your target in the hawk and the NASDAQ trades at $5 a tick, then you're looking at 10 ticks. If you were trading crude oil trades at $10 a tick, so that's only 5 ticks. Now, I will mention the more volatile markets like crude oil, I tend to double the profit objective. So on the crude oil hawk, I'm actually looking for $100 profit or 10 ticks. On the crude oil falcon, I'm actually looking for $200 profit or 20 ticks. And on the crude oil eagle, I'm actually looking at $400 profit or 40 ticks. All right, Sol asked about the 30-year bond. Here's the 30-year bond on the hawk scalper. And the 30-year bond, a little bit sluggish. They say the smartest traders in the world are the bond traders, and I believe it. You're not going to fool these guys too often. But we got a nice little first micro-macro cross signal right here during the London session, and we haven't really seen much during the North American session. We did get a 3-arrow consolidation right here, which we could currently be long on, but that's about it for the hawk for the bonds on the hawk. Let's take a look here at the falcon now. And we have kind of the same thing going on. Oh, a couple late filter entry signals. These are high probability signals on the falcon. When your filter goes out of sync, comes back into sync, but your trend line never changes color. Notice that. So that's a very high probability signal, and you can see it had some very nice follow through on it. During the North American session, though, looks like we've just got this one signal right here, our basic trend line touch signal. When the market retreats, touches the trend line, bounces out with a signal. So you could be long the falcon also on the 30-year bond. And let's take a look now at the eagle on the 30-year bonds. And we got our trend change signal back here about an hour before the North American Open, and very nice progression out of that so far. Yesterday, a little bit of a jumbled mess. We did get a green bar sell toward the afternoon. That would have been near the close, I imagine. And then the market tailed off. A very, very quiet few days through here. So no real trend signals on the bonds earlier this week, but things are starting to loosen up a little bit now. And there's your 30-year bond on the eagle. And I think it was Phil who was asking about the Forex. All right, here's the 6E, which is the Euro-US dollar cross. Hey, what a mess. So traders are always asking, hey, Eric, can you tell me how to trade a choppy market, or can you tell me when a market is in chop? Well, the Hawk is a great tool for that. When you see these little clusters of yellow bars printing all over the place and they're more or less the same latitude, that's a market that's in chop. So the euro right now in chop for the North American session, oh, actually even for the European session. Not very much going on with the euro right now, I'm afraid. So how do you trade chop? Well, the best way I know to trade chop is to let the market get outside of the range. Let it get out, let it prove it can stay out, and then look for that buy signal, and that buy signal will come. Or if it breaks to the short side, stop it. Let it get out, prove it can stay out, and then look for that short signal. But so long as you're trading in here, you're asking for it. You're just asking for the market to smack you around a little bit, because the buyers are going to be down here in the bottom half or bottom third. Sellers are going to be up here. Nobody wants to be in here. So we'll watch it drift down here, and then the buyers will start to buy it up again as it gets toward the bottom end of this range. So sit on your hands or look at a different market until you get outside of this range. That would be my suggestion for you on the NQ. And, oop, that's what I want down here. Or NQ on the euro, sorry. So there's the euro-US dollar pair on the Hawk. Sorry, it's not more exciting today. Here it is now on the Falcon. And you can see it's sandwiched between our primary resistance and our primary support, skewered by the median line. Yesterday, the market did a pretty good job of containing the lines too. Look, hit the secondary resistance line, down she goes, down to the median line, bounces up, hits the secondary resistance, down to the primary support. Oh, man. So, once again, it's got to get out of that range before you can really have confidence in one of the signals. It's not to say you can't take a trade, it's just that if you want a high probability signal, that ain't it. Maybe the eagle is producing a green bar sell here. We may see the euro break lower based on this green bar sell that we're seeing in the eagle. This tends to be one of our high probability signals, but it's pretty much the close of the European session, so I don't know if we're going to get a whole lot of follow through. You got to go back a few days to get a decent signal. Here's a trend change signal on the eagle with the euro. Nice follow through there. That actually occurred during the North American session, which is unusual because usually we see the euro more active during the European session, as you might imagine. This is a more active day, but again, still very, very sideways. So the euro not looking all that inviting at the moment. All right, a few more questions here, and then we're probably going to wrap things up for the morning. I just got to find where I left off so I don't miss anybody's question. Okay, ideal average target. And Bo asks about ticks and points. Tom asks, someone said that USO is less expensive than crude. Can USO be pulled up on NinjaTrader? That would depend on your data feed. Hang on one second here. I'm going to try it. There is the mini crude market, which you could also try. No, I don't have it in my data feed. Yeah, so there's mini crude, there's like the ETF derivatives. No, sorry, I don't get USO in my data feed. If you have the data, then yes, you can use the DTS or the Raptor to trade it. It's that simple. But yeah, if you're really a diehard crude trader and you're a little bit short on funds, you can try the mini crude market, which I think is QM, if I remember correctly. Tom asks, I had to step away, but can you Trade Manager and Trailblazer be used together? It's kind of redundant, Tom, because they're the same tool, slightly different. Let me demonstrate here again. If we're on the Trade Manager, now again, this is not a signal, I'm just demonstrating, and we have our stops enabled. If I click Sell Market, it will default to this value up here. So watch what happens. So I sell the market, I automatically have a stop in play because I have my stops enabled. I automatically have a break-even trigger because I have my break-even trigger enabled. But I don't have a profit target, and I don't have a way to take partial profits on a trade. That's where the Trailblazer comes in. The Trailblazer allows you to preset your profit or your quantity and your profit objectives, so you can have a runner in play, as I did on this trade. And when you hit the buy or sell market buttons, it will also give you your profit target along with your stop losses. So if you're just looking for one tool and you're concerned about overcapitalizing, losing trades, which I think every trader should be, then I think the Trade Manager might be the way for you to go. Now, that's not to say for those of you who have got the Trailblazer that, oh, did I make a mistake getting the Trailblazer? No, not at all. The Trailblazer has all the functions the Trade Manager does except the risk component. So you just need to do a little bit of homework, not a lot, a little bit, don't fret here, and think about how much is my average risk. Like if I put my stop up here, what's my average risk going to be? And based on that, I need to know what my average quantity should be. So one time you may end up risking 2%, one time you may end up risking 4%. So long as it's less than 5%, you're okay. It's those times that you end up risking 8, 9, 10% of your capital. That's when you're going to damage your account, right? That's when you're going to run into problems. That's when you're going to be afraid to come out of your office and your spouse asks you, so how'd you do today? And you say, oh, is there anything good on TV? Or I'm going to go for a walk. Phil asks, what about a stock? Sure, let me see what stock I can get. Let's see if I can still get this data feed. Oh, shoot. I just changed data providers recently, and some of the markets that I used to get, I'm no longer getting. Let's see if I can get, I don't know, Google. Nope. Where'd you go? Shoot. They're not giving it to me. I know Mike Filigera trades the stock market, Apple in particular. Apple, Netflix, and Tesla, those are his favorites. And I'm sorry, I'm unable to pull up any of them right now. I've been kind of a dyed-in-the-wool futures trader, so I've always looked at the futures alternatives. Can we ask who you use? Yes, absolutely. My data is through Continuum. That's not to say that they don't offer stocks. They do. I just haven't subscribed for that stock feature. They usually give you the big ones. Trading Apple, however, is pretty much the equivalent of trading the NASDAQ. If you put an Apple chart over the NASDAQ chart, they pretty much mirror each other. Well, thank you, Bo. Bo says thank you immensely. This is the best webinar I've attended in years. Much appreciated. Well, you're very welcome. I hope that you guys got a little bit out of this, and it's probably a good place to finish our webinar today. I suspect the market's either going to try to get into that gap, they keep creeping lower, or we're just going to see a little bit more sideways action. I'm going to roll to a tighter stop strategy now. Maybe go to my ATR. Yeah, that's all I'm going to give them right there. All right, folks, thank you very much for your attendance today. We're going to have another open house next week. And DTS owners, I will see you in the trading room tomorrow morning. Oops, yeah, Robert, hold on a second. I did miss your question. Robert asked, did you see my question about the initial balance lines and sizes? So, I have mine set like this. It's the default at 1 pixel. The plot size is line, and the dash style is dash. So maybe that will make a difference for you. And you'll need to do that for the other one as well. So dash style dash, plot size style line, width 1 pixel. And if you didn't get that, just shoot me an email and I'll send you those parameters again. All right, DTS owners, see you tomorrow morning. And everyone else, you're more than welcome to join us next Wednesday for another trading room. We'll see you then. Bye for now.